On the 6th of May, 2010, at 2:32 in the afternoon, the United States stock market began to behave in a way that had never been observed before. In 45 minutes, the Dow Jones Industrial Average fell by approximately 998 points. Nearly 10% of its value, shares of Procter & Gamble, a consumer goods company whose products were in virtually every home, dropped 40% in minutes. Shares of Accenture, a global consulting firm worth $30 billion, briefly traded at 1 cent. And then, within 20 minutes, most of it came back. With $1 trillion of market value, appeared, vanished, and partially reappeared, in less time than it takes to watch a film. This is the flash crash, 2010, explained. And the most important thing to understand about it is not what happened on May 6th. It is why nobody, not the regulators, not the exchanges, not the firms running the algorithms, had designed a system capable of stopping it. To understand what happened on May 6th, you need to understand what American financial markets had become by 2010. For most of the 20th century, stock trading was a human activity. On the floor of the New York Stock Exchange, specialists, individual traders with designated stocks, physically matched buy and sell orders, maintained orderly markets, and absorbed volatility with their own capital when necessary. The process was slow, it was inefficient, it was also remarkably stable. Beginning in the late 1990s, electronic trading began replacing the human layer. By 2010, approximately 70% of all U.S. equity trading volume was generated by algorithmic systems, computer programs executing buy and sell orders at speeds measured in microseconds. These systems were individually well-designed and individually well-tested. The problem was that nobody had comprehensively tested what happened when they all responded to the same market signal simultaneously. The dominant players in this new market structure were high-frequency trading firms, companies that made money not by having better investment insights, but by executing orders faster than everyone else. These firms typically held positions for milliseconds. They provided liquidity to the market, buyers when others wanted to sell, sellers when others wanted to buy, and collected a tiny spread between bid and ask prices on millions of trades per day. In normal conditions, this worked. High-frequency traders kept markets liquid and tight, but their participation was conditional on conditions remaining normal. As several researchers had documented before May 6th, including Andrei Kirilenko at the CFTC, high-frequency traders were not market makers in the traditional sense. When conditions became abnormal, they withdrew, and when they all withdrew simultaneously, the liquidity they had been providing vanished instantly. The firm at the origin point of the flash crash was not a rogue trader. It was not a poorly designed system. It was Waddell and Reed Financial, a Kansas City-based asset management firm managing legitimate institutional money, executing a legitimate hedging strategy. On May 6th, 2010, Waddell and Reed's portfolio managers were concerned about market volatility. European sovereign debt was in Greece's fiscal problems were creating genuine uncertainty about the stability of the Eurozone. As a hedge against portfolio losses, Waddell and Reed decided to sell 75,000 E-mini S&P 500 futures contracts. This was a large order, worth approximately $4.1 billion, but it was within normal parameters for an institutional hedging operation. It had been executed successfully before. The strategy Waddell and Reed used was an algorithm called VWAP, volume, weight average price, rather than executing the entire sell order at once, which would have depressed prices immediately. The algorithm sold contracts in proportion to the market's trading. If markets were trading heavily, the algorithm sold more. If trading slowed, the algorithm slowed. This was, and remains, a standard institutional practice. The problem on May 6th was context. The markets were already stressed by European news. Volume was elevated. The algorithm responded to elevated volume by selling more, which reduced prices, which triggered other algorithms to sell, which elevated volume further, which caused the Waddle and Reed algorithm to sell even more. A feedback loop had been created that no individual algorithm was designed to detect or stop. The fragilities that produced the flash crash had been documented before it happened. In 2000, Andrei Kirilenko, then chief economist at the CFTC, had published research identifying conditions in which high-frequency trader withdrawal could create liquidity vacuums in stressed markets. The research was circulated within regulatory circles. The specific scenario it described, a large institutional order in a stressed market triggering automated withdrawal, was consistent with what happened on May 6th. Circuit breakers, mechanisms to halt trading when prices move too fast, existed on individual stocks but not on the interconnected multi-market system through which the crash propagated. The E-mini futures market, the primary equity indices, and individual stocks were regulated time but regulated separately by different agencies with different rules. The structural problem was arbitrage between markets operating at different speeds. High-frequency traders operated across multiple venues simultaneously: NYSE, NASDAQ, BATS, the Chicago Mercantile Exchange. When the CME's E-mini futures prices began dropping, algorithms on equity exchanges detected the divergence and began selling equities to arbitrage the difference. The selling spread across venues in milliseconds. At 2:45, 13 minutes after the Waddell and Reed algorithm began, CME activated its own internal circuit breaker on E-mini trading. The pause lasted 5 seconds. When trading resumed, the algorithms reinterpreted the price level as a buying opportunity. In less than 20 minutes, most of the lost value was recovered. The recovery itself was evidence of the structural problem. The market had no fundamental reason to fall 998 points, and it had no fundamental reason to recover. It had simply run out of sellers. At 2:32 p.m., Waddell and Reed's algorithm begins selling E-mini futures. The market is already stressed by European news. Volume is elevated. At 2:41 p.m., high-frequency trading firms, detecting unusual price pressure, begin withdrawing liquidity. The available buyers for E-mini contracts decline sharply. The Waddell and Reed algorithm, sensing higher volume, accelerates selling. At 2:45 p.m., the CME activates a 5-second pause on E-mini trading. During those 5 seconds, traders across equity markets, operating without the futures price as a reference, respond to the last known price signal, which is wrong. Shares of Procter & Gamble drop 40%. Shares of Accenture reach 1 cent. Apple briefly trades at $100,000. These are not prices any rational actor would have accepted in a functioning market. At 2:47 p.m., 2 minutes after the E-mini pause ends, prices begin recovering. Algorithms reinterpret the bottom as a buying signal. The same speed that had amplified the fall now amplifies the recovery. By 3:07 p.m., the Dow Jones has recovered approximately 600 points of its losses. The Waddell and Reed algorithm had completed its 75,000 contract sell order during the crash. It had sold at prices lower than intended, triggering an estimated $68 million loss relative to the expected execution price. The firm had done nothing wrong. Its algorithm had performed exactly as designed. The design had simply not accounted for the environment in which it would operate on May 6th. The SEC and CFTC took 5 months to publish their joint report on the flash crash, releasing it on September 30th, 2010. The report identified the Waddle and Reed sell order as the trigger and the HFT liquidity withdrawal as the amplifier. It was technically accurate. What it did not resolve was the larger question: why had the market infrastructure allowed a single institutional order to propagate into a trillion-dollar disruption? The answer required confronting the fact that no single regulator had oversight of the complete interconnected system. The CME was regulated by the CFTC. The equity exchanges were regulated by the SEC. The two agencies operated under different statutory frameworks with different circuit breaker rules. When the crash crossed from one domain to the other, no unified response mechanism existed. In 2012, a UK-based trader named Avinder Singh Rao was eventually identified as having contributed to the pre-crash instability through spoofing, placing large orders he never intended to execute to create artificial price signals. Rao was charged and eventually pleaded guilty. His contribution to the crash was real but marginal. The structural conditions had made his spoofing effective in a way it would not have been in a slower, more human market. The circuit breaker rules were eventually updated across exchanges and asset classes. Market-wide circuit breakers, halting all trading simultaneously, were strengthened. The fragility identified on May 6th was partially addressed. Financial market observers have noted that the fundamental condition, algorithmic interdependence at speeds no human can supervise in real time, has not been resolved. It has grown. The standard version of the flash crash story focuses on the algorithm, a single fund sell program triggering a cascade. That version is satisfying because it has a cause and an effect. It implies that if the algorithm had been designed differently, the crash would not have happened. But Andrei Kirilenko's research and the 5 years of academic work that followed the SEC report suggests a more uncomfortable conclusion. The flash crash was not caused by one algorithm. It was revealed by one algorithm. The conditions for it, interconnected automated systems operating at superhuman speed with liquidity that was conditional on stability, regulated by agencies that did not share a common framework, were structural. They would have produced a similar event. Eventually, regardless of which specific order triggered it, the question the flash crash leaves open, and that financiers and academics are still genuinely arguing about is whether automated markets at this speed can be made safe, or whether speed itself is the risk, whether the Soluz Mimes Bilsger, whether circuit breakers, or whether circuit breakers the symptom of a system that has been automated past the point where human oversight is possible in real time. It is a question being asked in financial markets, is also being asked in artificial intelligence and infrastructure management, in autonomous vehicles, and in every other domain where automated systems have been given decision-making authority at speeds no human supervisor can match. If you have a view on where that line should be, the comments are open. The sources for every claim in this video are listed in the description, and the SEC's full joint report from 2010 is publicly available on sac.gov. It is one of the most readable government documents on a complex technical subject I have encountered, worth the hour.